The PSEI broke through the 6,500 resistance zone. Is this a breakout or a fake out? Let's discuss. My name is Dan Slim, and welcome to another episode of Monday Market Outlook. Manufacturing PMI numbers were announced early last week. It was the 9th straight month of manufacturing expansion as the PMI came in at 51.9. Remember that anything over 50 means an expansion in manufacturing activity, and 51.9 is actually a good number. However, this was lower than the 52.2 last April, but nevertheless, it was still a significant uptrend from the start of the year so far. Inflation numbers were also announced last week. Philippine inflation for May went up to its highest level in the last 5 months, rising to 3.9%, slightly up from 3.8 last April. Looking at the breakdown, it was housing, gas, utilities, and transport that nudged the inflation print last May. But if we look at the largest component of inflation, which is rice, we can see a 10 basis point improvement from April to May. Now, with the BSP projecting rice prices to further ease in the next few months, we should start to see inflation go down if this follows through. Though next month, we may still see a slight uptick as the lag effects of the peso depreciation in the past weeks, starting from actually this is March and this is May start to catch up with us. But this may actually be offset with the huge drop in US oil dipping to around $75 per barrel last week after OPEC announced a phase out of their voluntary cuts. Remember that OPEC cut production by 2.2 million barrels per day since October of 2022. So with this announcement, more than 500,000 barrels per day will return to the market by December, and 1.8 million barrels per day would come back by June of 2025. So we have a couple of inflation pressures, rice and oil, eventually easing in the next few months. So things may be looking up. Now, unemployment rate was also announced last week with the indicator rising to 4%, up from 3.9% in March, largely due to the loss of jobs, particularly in the agricultural sectors due to the El Nino phenomenon. Now, this translates to around 2.04 million Filipinos who are unemployed. But on a year-on-year basis, though, this is still an improvement over the 2.26 million unemployed from last year in the same period. So as we conclude the May foreign selling spree, let's finally put this one on the books and see how we compare this year's sell-off to previous years, especially in the last 7 years. So we have here 22 trading days this last May, and 18 of those 22 days resulted into net foreign selling. Which day was the worst? May 31, right? This follows the historical trends quite closely. Speaking of historical trends, let's look at the historical average monthly returns of the PSEI. Since 2016, we can see that the first 6 months are typically weak, with the PSEI down by an average of 1.3% monthly, but the June month starts off with a favorable second half with an average yield of around 2.1%, right? So things are looking up. And when is the best time to go shopping in the stock market? Let's look at this chart. The historical numbers also say that the best time to buy stocks are in May, June, and July. Now, what this means is that if you buy stocks in May, the average return over the next 6 months would be 2.1%. And if you bought in June, the average return in the next 6 months will be 3.2%. And if you buy in July, the average return is even better at 3.6%. So maybe in December, when we do this vlog, let's return and see if the stocks that we bought in these months will actually yield us the same returns, right? But if June is a good time for shopping, which stocks do we buy? Just highlighting some stocks here where the forward PEs of the top index stocks are actually below the pandemic levels, right? So particularly we have SM and URC. Now, SM, really one of my top bets, is a leader in the retail space. And if we just look at their financials, right, they are now way above pre-pandemic levels. And with the stock price oversold, this is an easy decision for me, SM. Let's look at the PSEI charts. The index ended the week above the 6,500 resistance zone to end at 6,518. So we mentioned last week that the market will move along this range here, 6.4 to 6.5, and then decides where it wants to go. And last Friday, we got a clue that the market may want to go to the upside this week. So we'll see, because we have a shortened trading week this week. Wednesday will be a holiday. Will we have subdued trading on Monday and Tuesday going into the holiday break? So hopefully we can have a follow-through week this week. The next level we have to watch out for, 6,600, then 6,674. So we'll see. So which stocks did I buy last week? So I did mention SM, one of my top bets. I mentioned that this was an interesting zone, 800 to 807. I was able to buy some at 810, 820. Let's see where it goes. I also bought AEV, of course, with the foreign sale of 3 billion net foreign selling for AEV last Friday. It was a chance to buy. Let's see if this will able to break through the 39 peso resistance. Wait for it to retrace and bounce off of that if you want to buy, or if it breaks out, retrace back to resistance, which is now support, and confirm the bounce. I also bought BDO, one of my favorite banks. Its PE ratio right now, 8.1 forward PE ratio. It is the cheapest it has ever been, with a price target of 170. This looks like a good time to buy BDO. I also bought in Metrobank. I mentioned that this was a very interesting zone for Metrobank. After the quick rejection off of this zone, I bought some Metrobank shares. I also bought Aboitiz Power, of course. After the consolidation here, I bought some shares of Aboitiz Power. It's giving out a dividend of around 6.57%. So this is a good area to buy Aboitiz Power. Manila Water also a good retrace. As we mentioned, for stocks that are trending higher, buy the dips would be a good strategy. So I was able to buy some at around 25, 60, and 27. So take a quick look at some of your favorite stocks. And remember, June, July is a good month to try to do some shopping. Try to identify some key levels on your favorite stocks. I would suggest for you to look at multiple time frames. Look at the monthlies, look at the weeklies, and look at the dailies, and see where these levels converge. Let's go on to some global news. The JOLTS, or the job openings labor turnover data, fell to its lowest level since February of 2021. This caused the markets to anticipate Fed rate cuts as early as September. As the job openings fall to a 3-year low, the 8.06 million jobs last April was a significant decrease from the 8.58 million last March. So this puts the ratio of openings to unemployed to just about 1.24. Back to normal, actually. If you look at the pre-pandemic levels, it was steady before it significantly dropped during the COVID period. Almost 0 job openings per unemployed person. Then look at this spike here in the openings, to the point where there were 2 job openings per unemployed person. And remember what happened here when people lost their jobs during the COVID. The US government gave them some cash dole-outs. They still had a lot of savings from the pandemic, and they didn't want to go to work. As a result, employers had to increase wages because there were more job openings than unemployed persons. They were forced to increase wages just to attract workers. They were chasing after the post-pandemic revenge spending. So what happened here? Wage growth were at crazy levels, and we were at the height of crazy inflation during this time. So is this enough for the Feds to consider cutting rates this December? Because Canada became the first G7 country to cut rates. The Bank of Canada cut rates from 5 to 4.75% last week. This was followed by the ECB also cutting rates last week for the first time since 2019, taking the key rate to 3.75% from a record 4%. But on Friday, the economy threw a monkey wrench as the non-farm payrolls report offered another signal that parts of the economy may still be too hot for the Fed's fight against inflation, as the market added 272,000 jobs last May, which was a significant number compared to the 185,000 expectation. Just look at that spike, feeding into a narrative of keeping rates higher for longer. We've had similar spikes before. And the thing with those similar spikes is that before the payroll Friday's report, a Bloomberg analyst stated that the Fed may be overstating jobs growth by around 730,000 jobs last year. So those upside surprises last year may be revised. So this upside surprise may be revised in the future. And if this is true, then the Fed may have their rate cut timings off and they may be late in cutting rates. Now, looking at this week, we have some critical data coming out. CPI inflation on Wednesday and the Fed decision on Thursday. So the key here would be the Fed press conference. While the market expects no rate change announcements after the June huddle, the release of the dot plot would give us a better indication of how many rate cuts we can expect this year and for the years to come. So as it stands, the markets had a dramatic shift in sentiment, now pricing in only 2 rate cuts after the jobs report last Friday. And if you look at the probabilities before the Friday jobs report, the market was still anticipating 3 rate cuts. As the good news or the positive jobs report numbers came out, it was bad news for the S&P 500 as the S&P 500 retreated last Friday to 5,343, but not before it hit a new high of around 5,376. The cooler than expected jobs report at the start of the week did cause the S&P 500 to surge past the 5,320 resistance zone here, which still resulted into a positive week for the markets. So for this week, the S&P 500 may retest the put support here while we await the CPI and inflation data on Wednesday. And let's see how the market reacts to the Fed minutes this Thursday. So where are we in this current bull market run? Now, if we look at the past 60 years, we are currently in a bull cycle with the same characteristics as the previous years. We have the Nifty 50 and the tech bubble during the 2000s. So we are now seeing a handful of stocks still leading the charge, and the upside still looks to be quite promising, as the average bull run would typically be around 65 to 75% range, and we are currently only at 53, so we could still have a long ways to go. And if we look at the equity sentiment, this actually rose by 67 basis points in May, and again, it looks like we still have a long ways before we encounter some bearishness for equities, right? So as we enter into 2 shortened trading weeks for the Philippine stock market, this week we will have the June 12 holiday, and next week we will have the June 17 holiday where the markets will be closed. Look at your favorite stocks and slowly buy into them. June and July are historically good months to buy into stocks. So good luck on your trades, and remember to manage your risk accordingly. But before that, do give this video a thumbs up, and remember to subscribe to the channel for your weekly updates. And as always, I will see you again next week. Bye-bye.